Yeah, I agree completely. In fact, let's pose that question to Abneesh Roy. Tamana, you want to take that? You had the opening thought with Abneesh.
Yes, Abneesh, my opening thought, if you could hear me. First of all, can you hear me, Abneesh?
Yes, now loud and clear.
Okay,
Thank
super,
you.
super. No, so I wanted to sort of set the context for our conversation on how you are looking at the numbers reported by all the majors in the consumption space and what that is telling us right now about their profitability.
No, I think Britannia, these are good numbers. If you see 6% plus volume growth and overall revenue growth of 8%, these are good numbers, and that's why the stock is up also. If you see this quarter, the palm oil has impacted all food companies and soap players. My sense is Q4 there should be some recovery because Q4 from day one the pricing growth will be there. While in Q3 the food companies took some hike, but it was not there for the full quarter. And in palm oil, we have seen some level of correction from the top. We also need to factor in the rupee depreciation because most of these are imported. I think the good results are from Britannia. If I see ITC, cigarette has done reasonably well, but in their FMCG, it was a severe impact on the profitability because of palm oil, because of maida being higher. And the notebook business also saw same issue of Chinese imports, and the overall margin pressure was there. So this quarter, we have seen that companies like Imami have done quite well. We have also seen the palm oil impacted companies like Godrej Consumer, HUL, Bikaji suffer a lot. And Britannia is somewhere in between. They have done reasonably well on the volume front. The gross margins are under pressure, but they have managed their other costs really well. So we are positive on Britannia, and we expect that pricing growth for Britannia will now become 2-3% from Q4, and FY26 could be even higher. So we are positive on Britannia.
How did you look at, for example, let me talk about a Trent and a Titan. And I think I heard you also asking a question on the Titan call, Abneesh. How would you look at some of these majors which have been street favorites and what their quarters then fared like?
Yeah, good question. So in any stock or any sector, we always see cycles. So Trent, if you see last 3-4 years, has done exceedingly well. But because of various reasons, for example, we have seen other competitors also ramp up. So Reliance is ramping up, Usta, Shoppers Stop is also ramping up Intune. And then last week, Reliance has tied up with Chinese player Shein. So that's the reason why any stock which goes up sharply and then there is slight miss also in Trend, for example, still from a sector perspective, it is sector leading growth. But now expectations are so strong that even if 2-3% miss is there, there is a severe impact on the stock. Trend stock has corrected a lot, and my sense is these are good buying opportunity. Last 2 months, of course, all high valuation stocks have corrected a lot. Generally, markets have corrected a lot. So more of profit booking. But if I see the numbers, frankly speaking, these are good numbers, and overall store addition is also decent. 34% growth in revenue, 34% growth in EBITDA. How can these be bad numbers? Versus expectation and premium multiples, that's why the stock has corrected. But my sense is that pain is now behind, because now in terms of Zudio and other formats, they will continue to be strong. And in India, kind of large markets, Shein, Reliance, Usta, and Zudio all can coexist. Coming to Titan, clearly in terms of margins, worst is behind. We have seen severe pressure in the jewelry margins. But in terms of the wedding season, next 2 quarters, we have strong wedding season. Plus price growth in gold will continue to help them. So we are positive on both the names, but from a structural perspective, these are very good quality companies. Titan hasn't corrected a lot, but Trent has corrected a lot. So I will say valuation comfort is now higher in Trent, and we will be positive on both the companies. So we have a buy on both the companies.
Yeah, actually, that was going to be my question, Abneesh, that is this the dip that somebody who wanted to always invest in Trent would have hoped for, and has it come? So you answered that question partly. Just wondering, I'll extend the conversation of Titan to the other gold jewelry companies as well, if you have them under your coverage. Any thoughts on any of the others aside of Titan? Because Titan is at one level of valuations, the others are maybe slightly different, of course, with reason. Any other coverage out there in the gold jewelry companies or gold retail companies?
So we cover only Titan, and that is the large cap company, and we like that. But on your question, yes, entire organized sector will continue to gain market share. Even Titan, which is such a large player, has got high single-digit market share, and the overall the unorganized space will keep losing market share to the organized players. So we think entire industry should do well. And in the next 2 quarters, Q4 and Q1, the wedding season is also very strong. Plus, the pricing growth will come because of the gold being at a high level. The only issue here is because such high sales numbers are there, the discounting is very high. And that's why the margin pressure is there for many companies. And the diamond part of the business is seeing pressure of the lab-grown diamond. And the diamond is a higher margin business. So we'll say that Titan is a preferred play for us. And that's why we have a buy on that. But entire organized space should keep taking market share from the unorganized.
Abneesh, hi, Alex joining in. On the valuation side, right, and you've kind of already answered that to a certain extent when you spoke about Trent and Titan, but I'm talking about the wider space as well. If we're talking about the Q3, as you've already pointed out, there are a few pockets where there were beats, but largely you are seeing question marks on the volumes, you are seeing question marks on the margins. Anticipating that will not materially change, at least heading into the next first quarter of next year, and you anticipate maybe second half a change, how does that affect the earnings picture and the multiples that you have traditionally given? We're not going to see that rapid growth that we were seeing in the past. So do you have to adjust your expectations on the earnings front and be okay with higher valuations? How do you see it?
Question. If I see staples, clearly worst is behind. Last 4 quarters, if you see, most companies have seen negative pricing. Now it has turned neutral for most companies. And from Q4, which is essentially first quarter of the calendar year, you will see that pricing growth for most companies in FMCG will be 2-3%. Now this is very important because that helps in operating leverage. Second is because of the union budget, the tax exemptions are there for all the salaried, which is a very big component, right? We are talking about 1 lakh crore for almost 30% of the taxpayers. There is no taxes, and for the rest of the people also, there's a huge tax benefit. So I will say urban slowdown, which is the key issue, that also should start recovering after some time. Like it doesn't improve from day one. I think the tax exemption will benefit all forms of consumption. It is not that only FMCG will see or only discretionary will see. Ultimately, I think both can see benefit, and it depends upon customer to customer. From an inflation perspective, if you see, crude oil is the main raw material for FMCG. It is almost at a 1-year low, just 3-4% away from 1-year low. You have to build in the rupee depreciation that partly makes it higher. But still, if you see, crude is going to be benign. Today, Trump has said that he will drive the crude oil prices lower. I think that's the main raw material for most FMCG companies. Coming to food companies, palm oil shot up 30-40% within 3 months, and it's around $1,200 currently. But if you see, in the past, we have seen palm oil at $1,800 also, and FMCG companies have managed margins. So it is more a case of volatility rather than the high margins. Rural demand will continue to recover. So my sense is HUL, Britannia, Dabur, all these companies, the valuation comfort is high. So I will not expect them to derate further. And last point will be, if you see, this year, most strategists are expecting a overall challenging year in terms of stock market, because GDP slowdown is there in India and globally also. So in that scenario, what we see is generally defensives do come back, and FMCG, as I said, a lot of positives now. Yes, the valuation comfort is also there. So I would expect that further derating is very unlikely in the FMCG. And in terms of Trent and Titan, valuation has corrected, but still it is not very comfortable. But from a 1 year or 6 months perspective, even Trent can do quite well, because the growth rate still, I think 30% plus is possible for Trent.
Okay. Abneesh, I'm sure, so you've already spoken about the companies that you like, but I want to push you a little bit to give us, if you anticipate in the overall picture, you've spoken about, of course, jewelry, you've spoken about fast fashion, but in the overall FMCG space, in your opinion, the most key opportunities, if you were to name 3, in your estimation, based on earnings trajectory and based on tailwinds coming together, which are the 3 ones that you would focus on most?
Yeah, so it's a tough question, because there are too many moving parts there. I'll take first where the earnings growth in the near term, medium term is strong. Those will be the liquor stocks. United Spirits, United Breweries, we are positive on both. One key reason is Andhra was almost zero for them. It will become 4 to 5% of the overall India business. And we have also seen that now there is a talk of the FTA, for example, raw material again. The glass cost is indirectly linked to crude oil prices. So if crude is soft, we don't see any problem in terms of the glass cost also. So that's on the high visibility in terms of numbers, next quarter, next 2 quarters. The marriage demand is also going to help in terms of the liquor demand. But valuation comfort is missing there. So that's the important thing, that you have to buy those on a bad day, but the earnings momentum will be with strong double digits in terms of revenue growth, EBITDA growth for both the companies. Now coming to stocks which have corrected a lot, worse themes behind, but the recovery will be gradual. I think HUL, Britannia, etc. look very good there. So I will name liquor stocks, HUL and Britannia as 3 names. But frankly speaking, because of the rural recovery and the union budget, I think all consumption stocks will see benefit. Some will see first, some will see later. But it's a large number, 1 lakh crore kind of a benefit government is giving. I think it will benefit all companies with some lag. Rural demand clearly is recovering. So these 3 names I like to shortlist.
Okay. Okay, Abneesh, we'll leave it at that. Thanks so much for taking the time out and being with us. Really, really appreciate your time. And consumption is the thick buzzing word.